Hello and welcome to this video on the risks and rewards of investing in startups. Investing in startups can be an exciting and potentially lucrative opportunity, but it can also be risky. In this video, we will take a look at the risks and rewards of investing in startups and provide some tips for mitigating those risks. Part 1. Rewards of investing in startups. Investing in startups can offer significant rewards for investors. Startups are often innovative and disruptive and have the potential to grow quickly and become very profitable. By investing in a startup at an early stage, investors have the opportunity to get in on the ground floor and benefit from the company's growth and success. In addition to financial rewards, investing in startups can also be personally rewarding. Many investors are drawn to the excitement and challenge of working with a startup and helping to bring a new idea or product to market. Investing in startups can also provide opportunities for networking and building relationships with other investors and entrepreneurs. Part 2. Risks of investing in startups. While investing in startups can offer significant rewards, it also comes with significant risks. Startups are inherently risky, and many fail within the first few years of operation. This can result in a total loss of investment for investors. In addition to the risk of failure, investing in startups can also be risky due to a lack of liquidity. Unlike publicly traded companies, startups are often not publicly traded, and it can be difficult to sell shares in a startup if an investor needs to liquidate their investment. Another risk of investing in startups is the potential for fraud or mismanagement. Some startup founders may not have the experience or expertise to run a successful business and may engage in unethical or illegal activities. Investors must be vigilant and conduct thorough due diligence to avoid these risks. Part 3. Mitigating risks of investing in startups. While investing in startups comes with significant risks, there are steps that investors can take to mitigate those risks. One important step is to conduct thorough due diligence on the startup before making an investment. This can include researching the company's management team, financials, and market potential. Investors can also diversify their portfolio by investing in multiple startups. By spreading their investments across multiple startups, investors can reduce their exposure to any one startup's failure. Investors can also work with experienced venture capitalists or angel investors who have a track record of successful investments in startups. These investors can provide valuable insights and guidance on the startup investment process and may be able to identify promising startups that are more likely to succeed. Conclusion. In conclusion, investing in startups can offer significant rewards, but it also comes with significant risks. Investors must be prepared to conduct thorough due diligence, diversify their portfolio, and work with experienced investors to mitigate those risks. By doing so, investors can potentially benefit from the growth and success of innovative and disruptive startups. Another important aspect to consider when investing in startups is the stage at which the company is in. Typically, startups go through several stages of development, including the seed stage, early stage, growth stage, and later stage. Each stage has its own unique risks and rewards, and investors should carefully consider the stage of the startup before making an investment. Seed stage startups are typically in the very early stages of development and may only have a prototype or a concept for a product or service. Investing in seed stage startups can be very risky, as the company may not yet have a track record of success or a proven business model. Early-stage startups have typically developed a product or service and are beginning to generate revenues, but may not yet be profitable. Investing in early-stage startups can be less risky than seed-stage investments, but still requires careful due diligence and risk mitigation strategies. Growth-stage startups are typically more established and have a proven track record of success, with a growing customer base and increasing revenues. Investing in growth-stage startups can be less risky than earlier-stage investments, but may also require a larger investment. Later-stage startups are typically more mature and may be preparing to go public or be acquired. Investing in later-stage startups can offer more stability and potential for a quicker return on investment, but may also require a larger investment. It's also important to consider the industry and market in which the startup operates. Some industries may be more competitive or have higher barriers to entry, while others may be more volatile or subject to regulatory changes. It's important to conduct thorough market research and due diligence to understand the risks and opportunities associated with a particular industry or market. In conclusion, investing in startups can offer significant potential rewards, but also comes with significant risks. Investors must carefully consider the stage of the startup, the industry and market in which it operates, and conduct thorough due diligence to mitigate those risks. By doing so, investors can potentially benefit from the growth and success of innovative and disruptive startups. Another important aspect to consider when investing in startups is the management team. The success of a startup often depends on the experience, expertise, and leadership of its management team. Investors should carefully evaluate the management team to ensure that they have the skills and experience necessary to successfully launch and grow a startup. Some key factors to consider when evaluating a startup's management team include their track record of success, their industry experience, and their ability to execute on the company's business plan. Investors should also consider the team's communication skills and ability to work together effectively, as teamwork is often crucial to the success of a startup. In addition to evaluating the management team, investors should also consider the startup's financials. Startups often require significant amounts of capital to launch and grow, and investors should carefully evaluate the company's financial projections and burn rate to ensure that it has sufficient funding to achieve its goals. Investors should also consider the startup's market potential and competitive landscape. The startup should have a clear understanding of its target market and how it plans to differentiate itself from competitors. Investors should evaluate the startup's product or service, marketing strategy, and customer acquisition plan to ensure that it has a viable path to success. Another important consideration when investing in startups is the terms of the investment. Investors should carefully review the company's legal documents, including the investment agreement, shareholder agreement, and term sheet, to ensure that they are comfortable with the terms of the investment and the risks associated with it. In conclusion, investing in startups requires careful evaluation of a variety of factors, including the management team, financials, market potential, and terms of the investment. By conducting thorough due diligence and risk mitigation strategies, investors can potentially benefit from the growth and success of innovative and disruptive startups. Another important aspect to consider when investing in startups is the exit strategy. An exit strategy is the plan for how investors will sell their shares in the startup and realize a return on their investment. There are several common exit strategies for startups, including an initial public offering, IPO, acquisition by a larger company, or a management buyout. Each exit strategy has its own unique risks and rewards, and investors should carefully consider which strategy is most appropriate for their investment. An IPO is the process of a startup going public and listing its shares on a stock exchange. An IPO can offer significant potential returns for investors, but also comes with significant risks and uncertainties. IPOs can be expensive and time-consuming, and startups may not be able to meet the stringent requirements of public markets. Acquisition by a larger company is another common exit strategy for startups. Larger companies may be interested in acquiring startups with innovative products or technologies, and may be willing to pay a premium for the startup's intellectual property and market potential. However, there is no guarantee that a startup will be acquired, and the acquisition price may be lower than expected. A management buyout is a type of exit strategy in which the startup's management team buys out the investor's shares. This can be a good option if the management team has a strong track record of success and a clear plan for how to continue growing the business. However, management buyouts can also be risky, as the management team may not have sufficient funding or expertise to successfully run the business. It's important for investors to consider the potential exit strategies when making an investment in a startup. Investors should have a clear understanding of the risks and rewards associated with each strategy, and should work with the startup's management team to develop a plan for how to achieve a successful exit. In conclusion, investing in startups requires careful consideration of a variety of factors, including the exit strategy. By evaluating the potential exit strategies and working with the startup's management team to develop a plan for success, investors can potentially benefit from the growth and success of innovative and disruptive startups. Another important aspect to consider when investing in startups is the legal and regulatory environment. Startups operate in a complex legal and regulatory environment, and investors should be aware of the potential risks and challenges associated with investing in startups in certain industries or markets. For example, startups operating in highly regulated industries, such as healthcare or finance, may face significant regulatory hurdles and compliance costs. Investors should carefully evaluate the startup's regulatory compliance strategy and ensure that it has a clear plan for navigating the regulatory landscape. Intellectual property is another important legal consideration when investing in startups. Startups often rely on intellectual property to protect their products or technologies, and investors should ensure that the startup has taken the necessary steps to protect its intellectual property, such as obtaining patents or trademarks. Investors should also carefully review the startup's legal documents, such as the investment agreement and shareholder agreement, to ensure that they are comfortable with the terms of the investment and the risks associated with it. It's important to work with experienced legal counsel to ensure that the investment documents are properly structured and that the investor's interests are protected. Another important legal consideration when investing in startups is the potential for litigation. Startups may face legal challenges from competitors, customers, or other parties, and investors should ensure that the startup has a clear plan for managing legal risks and has sufficient insurance coverage in place. There are several ways to find startups to invest in. Angel networks. Angel networks are groups of angel investors who pool their money together to invest in startups. These networks often have a screening process to select the most promising startups, so you can be assured that the companies you are investing in have been vetted by experienced investors. Crowdfunding platforms. Crowdfunding platforms like Kickstarter and Indiegogo allow startups to raise money from a large number of people. While these platforms don't typically offer equity in the company, they can be a good way to get in on the ground floor of an exciting new product or service. Startup accelerators. Startup accelerators are programs that provide mentorship, resources, and funding to early-stage startups. These programs often have a demo day where investors can see presentations from the companies in the program. Online marketplaces. There are several online marketplaces that connect investors with startups. Some popular ones include AngelList, Seedrs, and Crowdcube. These platforms allow you to browse and invest in a variety of startups from different industries. Personal networks. Finally, you can also find startups to invest in through your personal network. Talk to friends, family, and colleagues who may know of promising startups that are looking for funding. When considering investing in a startup, it's important to do your due diligence and research the company thoroughly. Look at their business plan, financials, and team to make sure they have a solid foundation for growth. Additionally, it's important to have a diversified portfolio of investments to mitigate your risk. In conclusion, investing in startups requires careful consideration of the legal and regulatory environment. Investors should be aware of the potential risks and challenges associated with investing in startups in certain industries or markets, and should work with experienced legal counsel to ensure that the investment documents are properly structured and that the investor's interests are protected. By doing so, investors can potentially benefit from the growth and success of innovative and disruptive startups. Another important aspect to consider when investing in startups is the cultural fit between the startup and the investor. Startups are often founded by entrepreneurs with a strong vision and passion for their product or service, and investors should ensure that they share the same values and vision for the company. It's important for investors to have a clear understanding of the startup's culture, management style, and communication practices. Investors should also consider whether they have the skills and experience necessary to add value to the startup beyond just providing capital. Investors should also consider the startup's social and environmental impact. Many startups are founded with a mission to create positive social or environmental change, and investors should ensure that the company's values align with their own. In addition to cultural fit, investors should also consider the potential for conflicts of interest. It's important to ensure that there are no conflicts of interest between the investor and the startup's management team, and that the investor's interests are aligned with those of the startup. Investors should also consider the potential for follow-on investments. Startups often require multiple rounds of funding to grow and scale, and investors should ensure that they have the capacity and willingness to provide additional funding if necessary. In conclusion, investing in startups requires careful consideration of the cultural fit between the investor and the startup, as well as the potential for conflicts of interest and follow-on investments. By ensuring that the investor's values align with those of the startup and that there are no conflicts of interest, investors can potentially benefit from the growth and success of innovative and disruptive startups. Thank you for watching this video on the risks and rewards of investing in startups.